Hey guys, Eric here, Mr. Fired Up Wealth. Today I'm bringing you my top 5 favorite growth stocks for 2021 and beyond. You're going to want to see this video. Stay tuned. All right, guys, I'm excited to bring this video to you today. It's going to cover my top 5 favorite growth stocks. But let me clarify, these are my top 5 favorite growth stocks for 2021 and beyond. They're also my 5 favorite growth stocks that I've been buying recently due to weakness. So a lot of these stocks, several of them I've had actually since 2019. I continue to dollar cost average as the story continues to improve and as opportunity arises. You know, stocks that have made big runs and have made pullbacks that I've been buying in Discord recently. So if you're in Discord, you can join Discord through Patreon. And there I teach you how I buy and sell. I literally share every one of my buys and my sells in this portfolio, in my taxable brokerage portfolio in real time. So you can see exactly the dollar amount to the penny of what I'm buying within seconds after buying it. I post it in Discord. And that's for educational purposes, really to teach you how to dollar cost average for long-term investing. So let me just show you a couple things before we get started. Okay, guys, so real quick, I'm going to show you this Discord and Patreon thing really fast, and then I'll get right into my top 5. So if you go to Patreon and look for Fired Up Wealth, there's going to be 3 tiers. There's a basic tier called the Fired Up Wealth General Chat Crew. And then there's the Elite Crew. There's the VIP membership. Now, the Elite tier is going to give you all the Discord channels from the General tier, the first tier, plus 8 hidden channels. And I'm going to show you a couple of those channels in a second. It's also going to give you a masterclass, which I just started creating. It's going to be releasing this month in November. And it's going to take you literally from A to Z on how to invest, from beginner all the way to intermediate and advanced, including technicals, fundamentals, options. It's going to be a great class, and I'm really excited about it. So anybody in the Elite tier or the VIP tier is going to have access to that class. We're going to release 2 videos a month. It's going to take several months for that to be completely finished. Now, in addition to the Discord chat rooms, we also have live streams. We do live streams every single Monday through Friday, Monday, Tuesday, Wednesday, Thursday, Friday at 9 o'clock a.m. Eastern time. That's 30 minutes before opening bell. We also do Fridays right at closing bell, which is at 4 o'clock p.m. Eastern time. We have a lot of fun on those. It's kind of like happy hour. We usually have special guests. In fact, the last 3 or 4 weeks, we've had a special guest that actually comes on. I interview them, and they share information about why they retired early, about starting businesses, all kinds of really cool stuff that we learned in there. So we do about 30 live streams a month. Those aren't recorded, but we do log notes in Discord. Now, the VIP is going to be all the same benefits from Elite, but it's also going to give you private one-on-one mentorship with me. So phone calls every single month. I'm not a financial advisor. I am a financial coach, but I've been doing this for 20 years, been very successful at it. And I literally teach you everything I know to help you be successful. So a couple things really fast, and then we'll jump right into the top 5 picks. So I want to give a special thank you, a shout out to these 17 people here on your screen. This is the VIP Founders Club. You guys are awesome. You literally helped get the group started from nothing, and I appreciate you. These are the people that I talk to and give private mentorship to every month. You can still get into VIP, but the Founders Club is now closed. There is a new VIP tier. And I wanted to show you really quick. So in Elite, there's actually 8 channels. I'm just showing you 2 here. The very top channel is called Eric's Elite Stock Portfolio. That's literally, it's a read only. It's just me posting to myself for educational purposes. And it shows you every time I buy or sell in real time in Discord. So if I literally do a buy or sell, I go within seconds and I go into Discord and I say exactly what I bought, how much I bought it for to the penny. I give you some fundamental analysis, some technical analysis of why I'm making the decisions that I'm making. And it's there again, as educational purposes. The channel below it is to talk about those stocks. There's 6 other channels I'm not showing you. Channels like technical analysis, options. I actually do some options trading. But most of us are long-term investors or swing traders. And we're trying to basically use technical analysis to dollar cost average in, use fundamentals so that we can perform and outperform the market long term. And this is just really quick. So if you join the very first tier, that's called the Fired Up Wealth General Chat. There's actually 31 channels in there. This is a sample of some of the channels you get. The information is very granular. You can turn these channels on or off, mute them, etc. There's also going to be chat rooms in there. There's going to be live stream rooms. Lots of great information. So without further ado, let's get kicked off with the top 5 growth stocks for 2021 and beyond. All right, guys, the first stock that I want to talk about today, I've been buying this stock actually since 2019, back in the 50s, but I have been adding to my position on some weakness, which I thought were really good earnings. And of course, this is CrowdStrike. And if you follow the channel, you know that I actually did a video on CrowdStrike that actually does a demo of the Falcon platform. So when you're done watching this video, feel free to go on Fired Up Wealth channel and watch that CrowdStrike video. It's very cool. So what is CrowdStrike? If you don't know what they are, real quick, CrowdStrike is a leader in cloud-delivered next-gen services for endpoint protection, threat intelligence, and response. The CrowdStrike Falcon platform stops breaches by preventing and responding to all types of attacks, both malware and malware-free. So if you look at your screen, you see APIs for plugins on the left and the right-hand side of your screen. And in the middle, you've got things like endpoint security, security and IT operations, threat intelligence, and the CrowdStrike store. So that CrowdStrike store is going to allow you to plug in CrowdStrike into your operations for, say you have Salesforce CRM or other SaaS subscriptions. You can basically plug this in so that it works throughout your entire organization. So at a glance, really quick. So this is the first cloud-native SaaS endpoint security platform. They like to consider themselves the best of breed in endpoint security, and they compare themselves often to like a Salesforce for CRM, which is customer relationship management, or a Workday, which is best of breed for SaaS, HCM software. They really consider themselves the best for endpoint security. I believe that to be true as well. And they're the first cloud-native SaaS endpoint security platform. So if you look at their financial profile, they have $791 million of annual recurring revenue. Now that's called ARR, and it's something that you'll see a lot if you're following these SaaS stocks. 93% subscription revenue, 7,230 subscription customers, which has grown a lot. And we'll look at that in a second. 87% ARR year-over-year growth, 89% subscription revenue year-over-year growth, and over 57% subscription customers have at least four or more modules, and they're doing a great job of building that out. They have other modules that they can basically cross-sell within their platform. So here's their expanding customer base. And you can see this is their subscription customers. If you look back in FY17, they had 450 customers, and that's grown exponentially. You can see 176%, 103%, 116%, 91%, but it's steadily grown from 450 to 1,200, 2,500, 5,400, now at 7,230, and that's for Q2 FY21. As of earlier this year, January 31st, 2020, they had 49 of the Fortune 100, 11 of the top 20 banks, and 40 of the top global 100 companies. Obviously, they've had time since January, so they've grown this number. So next I want to show you, this is an analyst that I follow, and I agree very much with what he has to say here, and I thought I would share it with you. He writes that he's taken advantage of the recent volatility in the stock. Just like me, I believe it was definitely a buy in the 120s, and even this range, I still think at $130 that it's going to be worth more than that in 2021 and beyond. That's what I believe. It's my opinion. And he says to upgrade it, given our belief in the company's strong fundamental opportunity, its favorable competitive positioning, and management's ability to execute. He adds that consensus estimates for the January 2022 fiscal year appear conservative. Overall, we believe CrowdStrike is well positioned in endpoint security with a solution fundamentally better than those of its legacy peers, and they expect continued share gains. The analyst says that while the work from home trend has been a tailwind for the company, it's by no means a requirement. He thinks, and I agree with him, that a shift towards cloud-delivered security software is here to stay. He also adds, we do not believe a return to office work results in any slowing momentum for the company. The analyst adds that the CrowdStrike offers a fundamentally better product with its cloud-based endpoint security solution than those offered by older players. We cannot overstate just how negative our channel feedback has remained on market share leader Symantec following its acquisition by Broadcom. That's ticker AVGO if you're familiar. And he expects to see CrowdStrike continue to pick up market share from these legacy players, including Symantec, as a result. Hey, I'm back. So this is a really cool chart too. This is talking about lifetime value versus customer acquisition cost. And so what this is basically doing is it's a ratio that measures the relationship between the lifetime value of a customer and the cost of acquiring that customer. That means these businesses here on the screen are very sticky, especially CrowdStrike, which can get over an 8 times return on investment for each client signed. You can see CrowdStrike is the best on this list. This was done by Credit Suisse. Palantir is actually pretty high as well at 6.8. Snowflake at 5.3. You've got Cloudflare. In fact, I own all this, the 1, 2, 3, 4, 5, the first 6 I actually own in my portfolio. I also own Zscaler and I own Elastic. I don't have any work, but a lot of people do like that in the Discord channel. And, you know, that certainly seems to be doing well in terms of this ratio. But 8.2x CrowdStrike is really the best out of all the SaaS stocks that we can analyze here, according to Credit Suisse. And that's pretty impressive. All right, guys, next I am going to, and I'm going to do this for every one of the picks today. I'm going to look at 5 charts. So we're going to look at the CrowdStrike chart. Now I'm down over here. So CrowdStrike, we closed at $132.18 on Friday. That was on Friday, November 13th. And it was down 3.73%. It's been churning quite a bit, but you can see this thing went from $32 back in the March lows all the way up past $150, and then it's pulled back. So this green line right here, every chart I'm going to show you a green line like that, that straight green line. That's going to be a resistance line. I'm using Fidelity Active Trader Pro, and we're looking at a year-to-date chart, and we're using daily candles on this. Now, the other indicators on your screen, this dark blue line that's going straight across, that's going to be a true support line, a long-term support line. This light blue is going to be your simple moving average, your 200-day simple moving average. This darker blue line up here is going to be your 50-day simple moving average. The red squiggly line is going to be your 20-day simple moving average. And then this orange line is a VMA, which a lot of people don't use, but I do like it. Every one of the charts I show you today are going to be like this with the same indicators. So that way you have an idea of what you're looking at. So you can see we basically were riding really nice here from that March point until about August or so. And then we kind of had a little bit of a pullback. And this is where I bought again. So I bought back in 2019 for around $50, $55. And I started adding, you know, we had a couple different earnings. I've been following the company. I really like what they've been doing. And the story to me has gotten better and better. So I started buying more around $109 a share. And then it rocketed from there up to $150. And now it has pulled back at one point, you know, in that $120 range. So we're kind of churning right in this point here. We're either going to continue to do that. You know, it's possible that we can break out, but you can see with these growth stocks, there's a long way to go. So if you're investing in these stocks, know that there's going to be risk and reward. There's going to be volatility. These stocks can run 20% in a day. They can drop 30% in a day. And what I always say with a high flyer stock like this is it's going to take the escalator up and the elevator down. And that's exactly what can happen with these stocks. So you have to be careful, but long term, I do like this stock. I think there's a lot of analysts that have $140, $150 price targets. And it's something where I expect it to have volatility, where it's going to run up to $150 and pull back to $120. I try to take advantage of those opportunities. So I bought at $109 right here. I bought again in this $125, $127 range, you know, a little bit early, but long term, it really doesn't matter that much. My cost basis is still less than $100 on this stock. And if it did go down as low as something like a 200-day moving average at $95, well, I'd be buying more. I always have cash, always ready for opportunities like that. So there's just a quick peek at the CrowdStrike chart. Hey guys, I hope you're enjoying this video. I've got 4 more picks. It's going to be the same exact format I just did for CrowdStrike, and you're going to want to see these. If this is helpful for you, at a very minimum, I'd love it if you'd subscribe to the channel. Hit the subscribe button on the bottom right-hand corner, and there's that little bell that gives you notifications. You're going to want to click that bell. That way, as soon as I release a new video, you're going to get a notification, and you can go check it out. If you like the video and it's helpful, please drop me a like. Please drop a comment. And if you're interested, and you can certainly check out the Facebook group. That's an absolutely free group. We have over 3,000 people in there so far. Make sure you fill out all the questions or we reject you. And then, of course, we have the Patreon and Discord for the really serious investors out there. Let's get going with the next pick. All right, the next stock on the list is Datadog. Now, this is a really exciting company, another high flyer that obviously is an expensive stock, but the growth is pretty amazing on this, and it actually is profitable, albeit not by a lot, but it actually brings in net profit margin. It's about even a little bit on the green side with some tremendous growth. And we're going to look at some information on this, but real quick, what is Datadog? A lot of people might not know what Datadog is. I do have a video on Datadog as well. It's actually a video on the channel that compares Datadog and Splunk. So if you're interested in that, check out Fired Up Wealth. Obviously, if this video is interesting to you and these type of stocks are interesting, definitely subscribe to the channel. So Datadog is the essential monitoring platform for cloud applications. We bring together data from servers, containers, databases, and third-party services to make your stack entirely observable. These capabilities help DevOps team avoid downtime, resolve performance issues, and ensure customers are getting the best user experience. This is a really cool comparison. I got this from a Seeking Alpha article called The Moment of Truth, and the source is down there if you want to check the article out. But this is actually comparing Datadog, New Relic, Dynatrace, and Splunk. Now, I used to own New Relic. I recently got rid of that one. Dynatrace is another good company. I've never owned the stock. Splunk I've had for a couple of years. I'm up pretty big on that one. It is a good company. If you're interested in the differences between, say, a Splunk and Datadog, again, check out that video on the Fired Up Wealth channel. But looking at this, so obviously you can see that these stocks are all really expensive. We already know that, right? When you look at something like, for example, the PE gap ratio, I mean, crazy stuff, but look at the revenue. Revenue growth year over year. Datadog is 80.77%. New Relic's only 18%. That's where I sold it. Dynatrace is 28%. And Splunk is 14%. The thing about Splunk, though, is they're doing something similar to what Adobe did, where they're going from more of an on-prem to a subscription type model. So they're doing much more of a cloud, and they're very focused on the ARR. So Splunk is a company that I still do like long, but it doesn't have as much growth upside, in my opinion, as a Datadog. Now, their gross profit margins are all about the same. Dynatrace, interestingly enough, is actually about 5% more than Datadog. Net income per employee. Now, this is pretty interesting. So Datadog is bringing in $2,500 per employee, and look at how much money New Relic's losing. $59,000 are losing. Dynatrace is bringing in $35,000 per employee, and Splunk is actually, according to this chart, losing $111,597 per employee, which is pretty insane. The market cap, 30 billion, 3 billion, 10 billion, 32 billion. Really interesting stuff, though. Very, very interesting chart there. There's another one I want to show you as well. Now, this one is comparing Snowflake to Datadog. Now, everybody knows that Snowflake is expensive, and it does have some amazing growth. This is a new IPO. I have a video on Snowflake as well. So if you're interested in Snowflake, it's called, before the IPO, I had a video that breaks down Snowflake. That information is still very relevant. Now, Snowflake's market cap is $67 billion versus $28 billion for Datadog. And the enterprise value, you can see, is roughly close to the same. Revenue growth, Snowflake 173% versus Datadog is 80%. Gross profit margin, though, is actually higher for Datadog, 78% versus 61%. And if you look at the total cash per share, it's 483 and 210. And the PE, well, Snowflake is still negative earnings. Datadog's PE, TTM is 632. Very expensive stock. But I do like it. It is growing. It's still an 80% year-over-year clip. And I think the stock over time continues to do well. It's had a recent pullback, just like CrowdStrike. And it got as low as $79, rocketed back to $90. And now it's kind of churning about $84. I think it closed around $84, $85. We're going to look at a chart here in a second, and I'll show you my thoughts on where I think the stock might be headed. So what this analyst is saying on the Seeking Alpha article is he's saying, hence, because of the research, and there's a bunch of other information you can go look at. We don't have time to read the whole article, of course. Hence, a price range of $108 to $110 would be more appropriate for Datadog. So right now it's trading, in the mid 80s, and he's saying it's worth, 20, 30% more at $110 a share. Moreover, with the APM market estimated at $7 billion in 2020 and projected to reach a size of $11.9 billion by 2027, Datadog can grow a lot more, and I agree. Additionally, the company has a strategic partnership with Microsoft. This is something new that made the stock rocket up over that $100 mark. and to make Datadog available to use directly with the Azure console, which is huge. Obviously, with Microsoft, their cloud is called Azure, and they have a partnership now where Datadog can work directly with that console, which is really, really important stuff. And I think it will help be a catalyst for their growth. This, in addition to the partnership it already had with Google, which is another, so I own Microsoft, I own Google. You see a trend here at all? A lot of SaaS. I work in IT. People that don't know, I actually work in IT. I've been in this space for about 10 years. I'm in sales, so I worked for Oracle. Now I work for a partner, and we do actually work with some of these companies like a Datadog and like a Splunk and like a CrowdStrike for integrations with our clients. So I have information about how these companies work. It helps me, make better decisions as an investor in this space. The company, so we talked about Google, the Google Cloud Platform, and existing alliance with AWS. So now Datadog is working with the three big dogs, which is Microsoft, Amazon, and Google. That's really important. These alliances are crucial in extending the company's presence throughout the world. This is good stuff, guys. Really, really good. Cloud is, if you listen to Peter Lynch, and you can look online for some, Peter Lynch information. There's a great book called One Up on Wall Street. But he talks about finding stocks that aren't in the first inning, but maybe in the second or third inning, that a growth cycle has, full 9 innings, like a baseball game, and trying to get in the early innings so that you can ride out. And I think there's several innings left in the growth story for cloud, which is why I like a lot of these companies. The company is diversifying into the security market, and it's a very small percentage of their business right now, but they are doing some work with security, and is projected to grow from $35 billion in 2020 to $68.5 billion in 2025 with what they call the Datadog security monitoring and compliance applications. So these guys are getting into more areas, trying to expand their footprint within their clientele. That's very good as an investor, in my opinion. Also, the debt to equity remains at a reasonable level, with the cash per share being $4.83. Hence, this is a capital efficient company with a free cash flow of $29 million as of September. And finally, with 75% recurrent revenues and net retention rate being over 130%, given the company's ability to retain and sell more existing customers, Datadog is a buy at current levels, according to this analyst, and I do agree with him. What is next, guys? Next is the Datadog chart. Stay tuned. All right, guys, back down here. Datadog chart. So this is, again, the 1 year. That's actually the year-to-date chart. Year-to-date chart with daily candles. Same exact screen that you saw when you watched the CrowdStrike chart. Now, this one's really interesting to me. If you look at the resistance and support, it almost looks broken on this chart, but you can see that we were trading way above this green line. So, I mean, we literally, this was at $85, and it basically traded up to $118 after that Microsoft news. And this thing is really in a tight range. Now, it could easily go down to $71, which is the 200-day simple moving average. But if you look at it, it really wants to try to hold this line. It might dip a little under and it kind of comes back up. So let's just look. This is now a 5-day, 10-minute chart, 10-minute candles, and it gives you a completely different look. You can see that this thing bottomed out really hard the other day. Basically, it got down to like $79 and change, like $79.76 or something like that. But basically, it wanted to find support at $80, and it did that. And it rallied from 79 and change all the way up to $90. And we bought it in the group, in the Discord group, right around the $80 mark, and it rallied up 12% up to $90, and now it's kind of come back down. But it did actually get some buying late in the day on Friday, and it did close back up over that $85, close to $86. It was down around 83 at one point. So we'll see what happens next week. I mean, I certainly think this thing could retest that $80 mark. If you look at some if you do a little bit more research and just look at it a little bit closer, I show it that it could go as low as $76.10. Of course, it could always go lower than that, but I think it would find some heavy support in that $75, $76 range if it were to go that low. I personally still like the stock in that $80, $85 range because I think it's going to go back over $100, probably less than a year away. And it already got up to that $118 range. So when it makes new highs, it's probably going to climb above that. As long as these guys can continue to perform well and continue the growth, I do think the stock will continue to do well over time. But remember, again, just like CrowdStrike, this is a very expensive stock, so tread lightly. The third stock is DraftKings. If you've been in Discord, we have been on this one. Now, first time I bought this was at 25. I bought it again around $33 before it made a big run up into like the mid 60s. And then it's kind of crashed back down to that mid 30s. And now it's back to the mid 40s. And we'll look at a chart here in a little bit and show you what's going on with this stock. But they just reported literally on Friday, the 13th, November 13th, 2020, they reported the third quarter earnings results, and they raised their 2020 revenue guidance. It says reports third quarter revenue of $133 million, increase 2020 pro forma revenue guidance to $540 million to $560 million, introduces 2021 revenue guidance of $750 million to $850 million. Those are some pretty good numbers. So Boston, November 13th, DraftKings, ticker DKNG, reported its financial results for the third quarter of 2020. For the 3 months ended September 30th, 2020, DraftKings reported revenue of $133 million, an increase of 98% compared to $67 million during the same period in 2019. After giving pro forma effect to the business combination with SB Tech Global Limited and Diamond Eagle Acquisition Corporation, as it had occurred on January 1st, 2019, revenue grew 42% compared to the 3 months ended in September 30th, 2019. And here's a quote: "The resumption of major sports such as the NBA, Major League Baseball, NHL, and in the third quarter, as well as the start of the NFL season, generated tremendous customer engagement," said Jason Robbins, DraftKings co-founder, CEO, and chairman of the board. "In addition to our year-over-year pro forma revenue growth of 42%. That's good. DraftKings recorded an increase in monthly unique payers of 64% to 1 million, demonstrating the effectiveness of our data-driven sales and marketing approach." When he says data-driven, they're using AI, and their AI is really good, and it's kind of a little bit sticky. It gets people kind of hooked a little bit, but it works. "Our product offerings and scalable platform provide a distinctive and personalized experience for customers across the 10 states. And we're going to get to more of that in a bit. I'm going to show you what's going on with the legal environment here in the United States, where we operate mobile sports betting today, and we look forward to entering additional jurisdictions at the earliest opportunity." So here are some of the highlights. It's a cool logo. I like that down on the bottom right. That looks pretty cool. $133 million of revenue driven by customer acquisition and return of major sports. So again, 42% year over year growth, $1 million in the MUPs in Q3, increasing 64% year over year. They grew industry leading OSB footprint, the largest of any online operator in the United States. They launched the OSB in Illinois and Tennessee, and live in 10 states for online sports betting. And it's good stuff. Continued to establish DraftKings as a top iGaming brand. That's something a lot of people miss. And I do have a video on DraftKings as well with more information about DraftKings. So definitely check out the Fired Up Wealth channel. I think this is getting close to my 100th video. Been going at it hard for about a year and a half. So definitely subscribe. There's a lot of great older videos, and I'm going to keep making videos like this in the future. #1 online casino brand in New Jersey. And then it says completed follow-up on equity offering. I'm going to get to the equity offering in a minute too, because there's still some more shares. So this is good stuff. All right, what else? Unique time for attractive customer acquisition. So pent-up demand, of course, right? We've been all locked down. Pent-up demand from suspension of major sports. We didn't have sports for a long time, and it was really sad. And heavy H2 sports calendar are key drivers of unique customer acquisition opportunity. The stay-at-home nature is driving increased response rates to advertising spend, and recent CAC better than expectations, even with scaled up customer acquisition spend. You can see the NASCAR slide is what I call it, when in sales, if you're presenting, trying to get a deal, you always show your customers and you put all the logos of all the customers you worked with. It's called a NASCAR slide. Like, here's our customers, and that's what this is here. And it's kind of funny because they actually have NASCAR on the NASCAR slide. That's something I've never I've never done, because NASCAR is not my customer, but they are they do partner with DraftKings. You can see the UFC's in here, NCAA, NFL, all the major sports guys, Masters, golf, even esports are on here. And I think that's going to be a big component to their growth moving forward. It's really, really good stuff. I'm excited about this one. It's kind of more of a spec play in some ways, but they are, I think, the best of breed for what they do. And I see a lot of growth opportunity for this company. So here, this is talking about their stock shares. This is important as an investor, and a lot of people don't pay attention to this. This was a SPAC type deal, so that you're going to have basically shares unlocked. Similar with an IPO, you have lots of different rules and everyone's a little bit different, but it's important as an investor to understand what's going on. So 80% of their common shares are already unlocked. That means they're in the market and they're being traded. And that's good, because you don't want like a ton of shares being flooded into the market, because it's going to dilute your shares. It's going to make the prices go crazy, all that kind of stuff, volatility. So I won't read all this and bore you to death, but just look at the chart here on the bottom left. So they had 392 million of their common shares outstanding. They've already unlocked 314 million. Now, after November 20th, so this coming week here, they're going to have, it looks like 14 million shares are going to unlock. And then again, January 4th, you're going to have 64 million. But then we're basically done. So we get to 2021 and we get to January, we're going to probably have some volatility, maybe a little bit, but you're going to see really fast what this stock can do, especially as the vaccine comes into play and things get back to normal. I do see this stock being almost like a rebound play in some ways, but it is an expensive growth stock and it is speculative as well. So let's talk about the election just happened, and there was a 3-state sweep. So Maryland, Louisiana, and South Dakota say yes to sports betting. And so legalized sports betting in the United States. As part of the 2020 USA election, prop measures to legalize sports betting were on the ballot in Maryland, Louisiana, and South Dakota. After being approved in all 3 states, the measures still require further action from each legislature. Legal land-based and online sports betting will be available in each jurisdiction at some point in 2021. There's a lot of opportunity, and I'm going to show you a map of the United States and show you what's going on. So let's just look at that now. So here's legal sports betting in the United States. I think this is a really important map if you want to invest in this company, to understand what is going on with sports betting and what the growth potential can be. So the dark red are live, legal single game sports betting. And there's 19 states plus Washington, D.C. The light pink, like Washington, South Dakota, Louisiana, Virginia, North Carolina, those are authorized sports betting, not yet operational. There's 6 states in that list. And then you see this kind of tannish color like Ohio. It says active 2020 sports betting legislation and ballot. There's 2 states on that list. There's no 2020 sports betting bills in 7 states, which is kind of the darker gray. And then that light gray, it says dead 2020 sports betting legislation. There's 16 states. So it's really surprising. Some of these conservative states, like it doesn't surprise me like some of the conservative states like Texas, but like South Dakota is generally a pretty conservative state, and they voted this in. And look at North Dakota right above it. Minnesota even doesn't have it. It's pretty interesting to me because South Dakota is a very red Republican type state for the most part. It's very conservative, and they not only they legalize sports betting, but they also legalized the other thing that was up for voting. And I can't say it on here because Google will flag me, but you know what I'm talking about. Up next, we have the DraftKings chart. Stay tuned. All right, I had to kick my wife out of the room. So we got the DraftKings chart. This is a year-to-date daily chart. Obviously it would have been great if you would have bought it at like $10 back here. I first started buying it. I actually traded it a couple of times in here, and I thought there's no way it could keep going up. And I was like, whatever. I didn't have a lot of information. I knew DraftKings. I had used DraftKings. I wasn't completely convinced, but then I started seeing more and more of these states saying, hey, we need tax dollars. We're in a lot of trouble right now. And the bells started kind of working. I was a little bit later than I could have been, but I bought it around 25 and decided to hold it. Now, we had this kind of run up to 40 and then it pulled back here into this mid 30s, low 30s price range. Bought some more in there and then it rallied all the way up to $64. And now it's made another pullback. The 200-day moving average on this chart here is 31.44. It's hanging in there pretty well. It kind of went way, overshot to the upside. Now it kind of pulled back and kind of went, pretty aggressively to the downside. And then the earnings were pretty good. We went over the earnings here a couple minutes ago, and lots of good stuff going on with legislation and things. So it seems like it's bullish again. It doesn't mean it can't, retest or sell off and maybe even go back to $30 or something. At one point I had it targeted at between 28 and 32 as kind of the low end. That might be close to the same range now, but I say if it's in the mid 30s, for me personally, I'm buying it. And I think it's going back to 60 plus. I like this one long-term a lot. DraftKings. How you doing? You need to get up and stretch or anything? I appreciate you hanging in there this long. Sometimes if you want to make something good and make sure you're covering all your bases, you got to spend some time and do some due diligence as an investor. So hopefully this is helping you guys. The next one is Teladoc. We're going to wrap this up here as concisely as I can. They just had earnings. I thought the earnings were pretty good, but the stock sold off. And in my opinion, it gave us an opportunity to add more shares. And, ARK Invest is doing the same thing. And I think it's a really good opportunity when it gets down here in the $170 some range. I just think with Livongo, it's going to be a great merger. Let's just look at the earnings here. They recently had these earnings and it says Teladoc Health reports third quarter 2020 results. The year-over-year Q3 revenues grew by 109% to 288.8 million. And the total visits increased by 206%. The year-over-year 9 months growth was about 79%, and the total visit increase was 163%. It also raised full year expectations, but people are thinking that when we go back to normal, that this stock and this company is going to be irrelevant. I'm telling you with confidence, in my opinion, they're wrong. This is a secular growth trend that's here to stay, and it's going to impact healthcare. It's a disruptive technology type stock. I like it too because it's technically healthcare, but it's also technology, and it gives me a little bit of balance. Here's a quote from the CEO. It says, "Our strong third quarter results exceeded expectations, driven by broad-based strength across the business and building on the momentum we saw in the first half of the year." And this was, again, from the CEO. "We are seeing significant market success and consistent growth in member visits throughout all of our commercial channels. With the addition of Livongo later this year, it's going to be a merger. We'll be creating a new category of whole person virtual care that will transform how people live healthier lives." That sounds good to me, and I'm going to show you what I mean in a second. Teladoc Health recently entered new and expanded client partnerships with industry leaders, including Guidewell, Johns Hopkins University, and Telefonica. Hopefully I pronounced that right. The company highlighted continued sustainable growth bolstered by increase in specialty visits, and registrations grew with ongoing diversity of visits. So let's check out this chart here. I think this really paints a great picture of what the merger between Livongo and Teladoc is going to bring to the table. It's going to empower whole person care as a single comprehensive partner across the full spectrum of health. And so look at the top left. It says complex care. Gain advice on a diagnosis, treatment plan, or surgery from world-renowned specialists. Then you have wellness and prevention. This is complete regular screenings, improved nutrition, exercise, well-being, mental health care, which is very important and something that's going to continue to grow, address stress, anxiety, and other conditions with therapy, counseling, and treatment. Now you have acute care. This is really important too. Assess, diagnose, and treat everyday health issues such as flu, infections, and skin conditions. Specialty care. Consult a specialist via virtual care and coordinate referrals to in-network, in-person care as needed. And then the chronic care. Take charge of health challenges while monitoring and giving personalized support. Now, that's why the merger is so important, because one did acute and one did chronic. Now together they have this entire compass that really, it covers everything that you need, the full spectrum of health. It's great. And don't just trust my word. Let's see what else Miss Kathy Wood has to say from ARK Invest. She says, Teladoc and Livongo have come together and they've established a working group focused on artificial intelligence and how to use the explosion of information they are receiving from providers and patients and insurers. Again, that's Kathy Wood from ARK Invest. Very good stuff. Up next, we have the Teladoc chart. All right, guys, this is the year-to-date, another daily candle chart. And you can see, according to this, at least on Fidelity, 174 range is a pretty strong support line. And it basically just dipped under that and kind of bounced off of it. But it hasn't recovered really great. It's certainly doing a lot better than it was at, this $170 mark, but you can see it's about $183 right now. I have a strong gut feeling that it's probably going to stay between 174 and this 218 line, bounce around a little bit, and eventually it's going to take off. It was about $250, and like most of the stocks we're covering and talking about today, it made a run up. It overshot to the upside, went past the resistance, and instead of breaking out more, kind of came back to the earth. It kind of traded along that $200 to $220, $230 range for a little while, and then kind of came back down to earth. So, this took, away quite a bit of time on a chart. This goes back until basically June, where it was that price last. So ARK Invest has been buying a lot of shares. I've added a lot of shares. I'll continue to add, especially if it goes any lower. So, it's certainly possible that I could even break this support anytime and go even lower. But to me, it doesn't make any sense. People are selling it because they think that we're going back to normal and that telemedicine won't be important anymore. But like I said earlier, I think that this secular growth trend is here to stay. The execution is going to be most important. Anytime you have a merger, that execution between the two different cultures is going to be really critical. But if the management can do a good job with that, I see this company doing very good things. All right, guys, last but not least, we're going to talk about Marvell and Inphi and that acquisition. Now, you probably noticed a trend. Every single one of these stocks, I have a video on the channel. So if you like these type of picks, of course, subscribe, as I've been saying throughout the video. But I literally have a video on all these, and I've been buying these stocks for a while. So if you look at Teladoc, I was buying that stock in the 80s. If you look at CrowdStrike, I was buying that in the 50s back in 2019. I was buying Datadog last year. Now, Marvell is one of the newer ones, and I liked it before the acquisition announcement. This acquisition is a really big deal, but I like it even more with the acquisition. So it's official. Marvell is acquiring Inphi for $10 billion. That boosts its cloud and 5G opportunities. So Marvell, we develop and deliver semiconductor solutions that move, store, process, and secure the world's data faster and more reliably than anyone else. Inphi is the leader in data movement interconnects between and inside data centers. We move big data fast around the globe with high quality and reliability. This is really cool stuff, and I think this is a great acquisition. I'm really excited about it. And on Friday, they had Fast Money has a show. They do a fast pitch, basically trying to get people to say, hey, this is a stock I think you should buy, yes or no. And people go on Twitter and vote yes or no. And I went on and actually said, absolutely yes. And I posted my video on the link, shameless plug. And I got a retweet from Nigerian. I was pretty excited about that. So check out Twitter, follow the channel on Twitter, Fired Up Wealth on Twitter. But that made my day on Friday. I was really excited. So this one was up after hours on Friday. And, we did a really good job in the Discord group. When this acquisition was announced, Marvell stock dropped down to about $35, and a bunch of us bought it. And of course, it rallied up from there. Now it's close to the mid 40s here, so it's doing really well. So Marvell creates U.S. So this acquisition together is going to accelerate growth and leadership in cloud and 5G. Now, Marvell is also working on autonomous chips for autonomous driving, so I think that's going to be a good play for them in 2021 and beyond as well. But together, now this acquisition is not going to happen until the second half of 2021, but nonetheless, I'm excited. And what it will do is create a U.S. semiconductor powerhouse with an enterprise value of about $40 billion combined. The positions Marvell for leadership in cloud and extends the 5G opportunity, adds Inphi's leading electro-optics interconnect platform in a highly complementary transaction, expands Marvell's addressable market to $23 billion and accelerates market growth to 12% CAGR. Combination expected to double the number of $100 million plus cloud and networking customers to 8 customers. So trying to play with the big boys. Obviously, I do like AMD stock a lot. I like NVIDIA stock a lot. This is a much smaller company. I still, I like this one as well. There's quite a few semiconductors. I call semiconductors the next oil, and it really is. Data is the next oil, but it needs semiconductors. You need data, you need semiconductors for data. So it really is the next oil. It says, accretive to revenue growth, gross and operating margin enhances long-term financial model. The other thing I noticed too is that, I'm going to read it here. It says the combined company will basically be a U.S. company. Right now, I want to say that Marvell is like headquartered, or it's not a U.S. company, it's Bermuda. And so by doing this acquisition, it's going to be back in the U.S., headquartered, I think, in Santa Clara, California. So in San Francisco, that's good. That's where we want our tech companies to be, right? So what else? So there's their logos down there. It's pretty cool. I want to read these quotes. Our acquisition of Inphi will fuel Marvell's leadership in the cloud and extend our 5G position over the next decade. This is something I want to be a part of for my portfolio, said Matt Murphy, president and CEO of Marvell. Matt Murphy has done an excellent job. They sold some of their assets. They've made some acquisitions. Even before this acquisition, they positioned themselves really, really well. Inphi's technologies are the heart of the cloud data center. Heck yeah, that's what we want. And they continue to extend their leadership with innovative new products, including 400 gig data center interconnect optical modules, which leverage their unique silicone, blah, 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 blah. They even have some 800 gig stuff they're working on too, I saw on their website. We believe that Inphi's growth presence with cloud customers will also lead to additional opportunity for Marvell's DPU and ASIC products. Marvell and Inphi share a vision to enable the world's data infrastructure, and we will both have transformed. They've done a good job of transforming their respective businesses to benefit from strong secular growth. That's what we want. Expected in the cloud data center and 5G wireless networks. That sounds great to me, said Ford Tamer, president and CEO of Inphi. Combining with Marvell significantly increases our scale, accelerates our access to next generation of process technology, and opens up new opportunities in 5G connectivity. Upon closing, Ford Tamer, Inphi's president and CEO, will join Marvell's board of directors. You have to be careful with both of these companies because Marvell, you want to call Marvel, like Marvel Comics, and Inphi, you want to call Inphi, and it can be a little bit tricky. So anyway, I like this one. Next, we're going to look at a chart. All right, guys, here is the Marvell chart, and you can see this is where I was talking about earlier, where it kind of sold off. Actually, it's right here where it sold off. So we kind of dipped down here. It looks like this was end of August when everything kind of sold off. And this is where the acquisition announcement of Inphi was, where it got about to 35. We were buying right in this range, and then it popped up, again to 45, and then it's kind of pulled back and it kind of bounced pretty well, actually. It was up 4%, and I think it was up again after hours. So it's, it definitely is a good stock. I think it's a $50, maybe $55 stock in a year. It does pay a small dividend. So this is one it's the only one on this list that pays a dividend. This would be considered a DGIF. So if you look at, CrowdStrike, Datadog, Teladoc, those are kind of growth, kind of growth spec, hybrids. DraftKings would be much more in the spec category, but I feel really confident about that. I think I said, Tesla and DraftKings are two of the specs I have probably the most confidence in as an investor. And then you've got this, which is, a DGIF, and the company has really it's been around for a while, but it's really evolved over the last several years. And I think they're positioning themselves really well to succeed over the next decade, like the CEO has said on the previous quote. So, this thing easily could trade back down to 35 or even $30 if the market kind of, fell out. It's made a big run. The floor really isn't all the way down to below $30 here on this chart, but I do like it. I think it probably has potential to break out, especially if the market keeps doing well. I'm going to hold this stock, for several years. I see it being a good performer in 2021 as well as beyond. There you have it, guys. My top five, my favorite 5 stocks for 2021 and beyond. I hope you enjoyed this video. Please do subscribe, like, comment. It helps me out a lot. I literally just spent my entire Saturday making this video. I'm actually pretty tired. My voice is starting to wear out. So I hope you appreciate the energy that goes into these videos. I have a lot of fun doing them, and I like to help people. Hopefully it is helping you. You know, you can definitely check out our Facebook group as well. That's absolutely free. You can get in there and make sure you answer all the questions. And if you are a new investor, even if you're an advanced investor, if you're looking to learn, the best place for it is going to be in Discord, and you get there as being a patron. So all you got to do is just look for, you know, go on Google, type in Patreon plus Fired Up Wealth. It'll take you right there. I'll also put a link in the video description if you want to just click right to the URL. Look at the different tiers. Consider joining us. It would be a lot of fun to have you. I'm actually at the point where I'm going to start doing this as my full-time gig, and it's only going to get better. The more time I have, the better quality I can deliver to you. So I'd love to have you part of our group. We've got 215 people in Discord through Patreon right now, looking to, you know, get some more people in there, but at a certain point we do cap it off. We're not going to just keep growing forever. We're going to keep the quality by keeping it smaller. So if you want to check it out, the nice thing is it's month to month. So join for a month, and if it's not up to the level you think it is, then you can depart. You can cancel anytime. So check that out, guys. I do appreciate it. Again, please subscribe, like, comment. I hope you have a great rest of your day. Take care.